One of the most challenging accounting principles is something that gives owners, managers, and other accountants inside of the construction industry, it gives them problems. And this principle has two accounts that everybody knows: over and under billings. The actual name of those accounts is cost in excess of billings and billings in excess of costs. A recent pronouncement came out, and now they're called contract asset and contract liabilities. I like that a lot better. It's a lot simpler. But these accounts do give people problems. And they give people problems because it's algebra. Now, one of the rules behind the construction industry is how you have to recognize revenue. And this is called the percentage of completion. Now, if you think of percentage of completion, basically that means how complete is the job, and if you know how complete it is, you bill that amount to the client or to the customer. One of the problems you can run into is determining how complete the job actually is. Now, sounds easy, can be hard. A lot of the business owners will bill what they feel the job is at without looking at numbers. And sometimes that's appropriate. However, billing this way can lead to an accounting problem. So how do we get to this problem and how do we get through it? Those two accounts do help you, but first we're going to run through an example. Let's say you have a job that you're bidding on, and in that bid you determine it's going to take $80,000 worth of costs. However, you do need some profit to help pay yourself and to pay your administration expenses. So you build in a $20,000 profit margin into that job, and the total contract is now equal to $100,000. Now, a month later, you've made some progress on the job and your costs are coming in, you're paying your vendors, you're paying your people, and now it's at the end of the month, it's time to bill the client. So you bill them $40,000 because that's what you feel the job is at. However, when the accounting department starts doing their closing, they find that there was only $24,000 of costs associated with this job. Now, this is where the algebra comes in. You take the $24,000 and you divide it by the $80,000 of total costs, and you find out that you're 30% complete. However, if you remember from earlier, we billed $40,000. So right now, $40,000 is sitting in your revenue. However, due to the accounting problem, there's $30,000 that you've actually earned. If you didn't make these adjustments, what you would see is a $40,000 revenue and $24,000 worth of costs, which would show a gross profit of $16,000. Now, if you do that math, 16 divided by 40 is 40%. And I don't know any business owner who wouldn't be thrilled with a 40% gross profit. However, that is not actual. So how do we get the numbers down to what they actually are? We've now circled back to those original accounts that I was talking about, the contract asset and the contract liability. In this case, the owner has billed $40,000 when he's only earned $30,000. So there's a debit that needs to happen to the revenue account of $10,000 and a credit to another account. Now, where does that account go? It's called contract liabilities. Contract liabilities sits on the balance sheet, and it kind of acts as a deferred revenue. The deferred revenue is a place where prepayments come in, or a place where receivables that have been billed but haven't been earned, that's where they sit. So to make this accounting entry, you've got to debit the revenue of $10,000 and you credit this contract liability of $10,000. What this will do, it will bring your revenue on your income statement from 40 down to 30 and show that you had $30,000 of revenue and $24,000 of cost and a $6,000 gross profit. Now, if you compare those 2 months, if you were going to make a decision, you would rather know that $6,000 is how much you made rather than the 16, because that could lead to a bad business decision because you're using money that you haven't really earned yet. So let's talk about the opposite. What can happen on the opposite side? Well, let's take the same example, and instead of billing $40,000, he bills $24,000. So when you're looking at a revenue at that point, you've got $24,000 sitting in revenue and $24,000 sitting in costs, which means your gross profit is zero. Now that will strike fear into any business owner. So you really want to know what your gross profit is. So in that case though, everything's been underbilled because the owner didn't consider any of the profit when he was making his billing. He was making his billing of $24,000 based upon the costs that were in the system of 24 and wanted to cover those. Now, in some ways that makes sense, but it doesn't account for the 20% of profit. So in this particular situation, the accounting department would do their close and they would find a $6,000 difference because what should have been billed was 30. So in this case though, we've got to credit the revenue for $6,000. We have to debit $6,000 to a contract asset, and that asset is a place where unbilled receivables are sitting. So it's a place that you should have billed, but you haven't, and that's where it sits. It's a deferred asset account in some ways. So underbilling and overbilling, what it does, it adjusts the income statement back to what was actually earned, because costs are constant, and the costs, when compared to the total costs, give you the percentage complete, and that gives you your right revenue. Now, all your costs are going to stay the same. The only number here that's changing is revenue. You do want to know what your net income is so that you can know where you stand as a company.